Today, it's wall-to-wall inflation in New Zealand. Hello again, it's Martin North from Digital Finance Analytics World Latest post covering finance and property news with a distinctively Australian and New Zealand flavour. Well, inflation has hit its highest level in New Zealand since 1990. But the 6.9% figure as at the March quarter is actually somewhat below market expectations, which were for a figure of 7.1%. The latest 6.9% figure is though up from 5.9% as at December 2021, and it's close to what the Reserve Bank of New Zealand was expecting. Now, of course, they had suggested that inflation would peak at around 7% in the first half of this year. Now, the key non-tradables, in other words, domestically generated inflation figure, is at around 6%, up from 5.3% in December, showing that there is a great deal to do in terms of controlling rising prices within the country. Now, of course, the Reserve Bank is targeted with keeping inflation at between 1% and 3%, and explicitly targeting 2%. And Governor Adrian Orr has conceded that the central bank is, quote, not in a great place now with inflation. The Reserve Bank of New Zealand's main weapon, of course, against inflation is the official cash rate, which was raised by 50 basis points to 1.5% last week, and you can expect much more hiking in the months ahead. Stats New Zealand said the Consumer Price Index increased 6.9% in the March 2022 quarter compared with the March 21 quarter. That's the largest movement since a 7.6% annual increase in the year to June 1990. The 6.9% increase follows that annual increase of 5.9% in the December 21 quarter and the previous largest annual movement since the 7.6% increase in the June 1990 quarter, which occurred shortly after the Reserve Bank of New Zealand Act 1989. The Act came into effect in February 1990 to target the high inflation from the previous decade and to maintain stability in the general level of prices over the medium term. Now, the main driver of the 6.9% annual inflation read to March 2022 was the Housing and Household Utilities Group, influenced by rising prices for construction and rentals for housing. Prices for the construction of new dwellings increased 18% in the March 2022 quarter compared with the March 2021 quarter. That's the largest increase recorded since the series began back in 1985. Construction firms have been experiencing many supply chain issues, higher labour costs, and also higher demand, which have pushed up the costs of building a new house, Stats New Zealand said. The next largest contribution to the annual inflation was from the transport group, influenced by higher prices for petrol and second-hand cars. Petrol prices increased 32% in the year to March 2022. That's the largest annual increase since the June 1985 quarter. The price of a litre of petrol increased steadily over January and February, and in the second week of March, the average price of 91 petrol at the pump was $3.05. Prices then dropped following a decrease of 25 cents per litre in fuel excise duty, and that's expected to remain in place for 3 months. But prices for fuel are volatile, Stats New Zealand said. To capture this change and accurately measure the average fuel price over the whole quarter, they sample prices weekly from key sites in New Zealand. But like any sample, this may not include the highest or the lowest prices paid in any period. The average price of 1 litre of 91 octane includes discounts, increased 8.7% to $2.67 in March 2022, compared with $2.45 in December 2021. And petrol prices increased 8.3% for Auckland, 8.5% for Wellington, and 8.6% for Canterbury in the March 22 quarter. Construction of new dwellings, rentals of housing and cigarettes were the next largest contributors to the overall quarterly rise. The price of cigarettes rose 4.5% in the March 2022 quarter, following an increase in excise tax on 1 January 2022. This is the second year in a row with smaller price rises for cigarettes due to excise tax increases being reduced, they said. The tradable inflation was 8.5% in the year to March 2022, the biggest annual movement since the series began in June 2000. Tradable inflation measures goods and services that are influenced by foreign markets, such as petrol, vegetables, and second-hand cars, which were the biggest contributors to the movement. Domestic or non-tradable inflation was 6% in the year to March 2022. That's the highest since the series began in June 2000. Higher prices for construction, rentals for housing and local authority rates were partially offset by domestic air transport. Non-tradable inflation measures goods and services that do not face foreign competition. It shows how domestic demand and supply conditions are affecting consumer prices. Increasing costs of imports pushes up food prices, and the impact of prices for imported commodities really does flow through into things like food production, petroleum and petroleum products, and a lot of other categories too. So the external drivers coming into New Zealand are definitely lifting prices. But of course, less visible but equally important to production are perhaps those embedded in things like food waste used as animal fodder, which was up 39%, and fertilisers, which was up 161%, and mechanical machinery used in sectors relating to food production, which was up 14%. Inflation rates around the world, of course, are currently higher than in recent years, with the OECD total at 7.7% for the year ended February 2022. But the United States was at 8.5% and the United Kingdom was at 7% in the year ended March 2022. Ben Uddy, Australia and New Zealand economist for independent economic researchers Capital Economics, said the first quarter inflation figure was broadly in line with the Reserve Bank of New Zealand's expectations, which reduces the likelihood of another 50 basis point hike in May. The 1.8% quarter-over-quarter rise in inflation was below the analyst consensus of 2% over the quarter, but was enough to take annual inflation to a 30-year high of 6.9%. Looking ahead, we think inflation is now around its peak. The government's reduction in excise taxes should reduce fuel costs in the second quarter. What's more, as house prices are now falling, we think home building inflation will ease before long, and base effects mean the pace of quarterly price growth would need to ramp up further to lift headline inflation again in the quarters ahead. And the Reserve Bank of New Zealand noted at its April meeting that it expected inflation to peak at around 7% in the first half of this year. As today's data is broadly in line with that forecast, the chance that the bank hikes rates by another 50 basis points in May is now diminished, he said. Still, there is an expectation that inflation will remain well above the Reserve Bank of New Zealand's target through 2022, so there is still a very good chance that the bank will hike rates up to 3% by the end of the year, he said. And so you can see all of this flowing through, but let me just stress again that the official read on inflation is, of course, a bit of an average, and many households will be much more badly hit, and particularly those on relatively low incomes. In fact, I think there needs to be some deeper analysis done on how inflation is impacting different consumer groups, because certainly the research that we do here in Australia suggests that those on lower incomes who are paying a greater proportion of their income on non-discretionary items are experiencing very significant lifts in inflation well above the publicly quoted figures. And I'm pretty confident that the same is true in New Zealand. So like it or not, I think central banks should be marked a fail on their recent strategies. They took rates too low, they did too much quantitative easing, and now they're reaping the whirlwind. And sure, Ukraine is adding to the costs of oil. But remember that inflation was on the rise before the Ukraine crisis blew up. So a lot of this is actually self-inflicted thanks to inaccurate strategies set by central banks around the world. Of course, they won't admit that. They will blame externalities. They will actually blame everybody but themselves. But the fact of the matter is, bad years of policy are now coming through. Inflation is way off the scale. And I don't think that wage rises will be tracking anything like as fast, which means, of course, in real terms, real incomes are going backwards. That's a very bad situation for many households who, of course, will hunker down, spend less, and try and find ways to save money, especially as interest rates are set to continue to rise. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.